everyone, and welcome to our Toronto Centre webinar. I'm Jerry Lewis, and I'll be your host for today's session. Thanks very much for joining us. Our topic today is FinTech, a driving force for financial inclusion. Our session today will be approximately 30 minutes, and after the event, an archived version can be found on the Toronto Centre website for viewing at a later time. Questions and comments may be posted at any time during this session. All questions will be responded to after our event and will be sent to you via email. Finally, to improve our webinars and to learn about topics you're interested in, a survey will be sent to you after this session. Your feedback is very important to us, and we hope you'll take a moment to complete it when you receive it. At this time, I'd like to invite our first guest. He is Christopher Wilson, Senior Financial Sector Expert at the Monetary and Capital Markets Department of the IMF.
Hello, and thank you for the opportunity to speak on behalf of the IMF on the topic of FinTech and financial inclusion. I will begin with an overview of FinTech, covering issues such as definitions and impacts. Then I will move to the benefits of FinTech and in particular for financial inclusion. Next, I will turn my attention to the regulatory and supervisory issues associated with FinTech. And finally, illustrate the concepts using several case studies. So what is FinTech? FinTech is broadly defined as computer programs and other technology used to support or enable banking and financial services. FinTech is dramatically changing the financial services landscape, and the investment in FinTech is vast. For example, investment in FinTech by venture capital, measured in US dollars, has increased from approximately $1 billion in 2010 to almost $14 billion in 2016. While technology has always played a part in the provision of financial services, the use of technology in the recent period has become more pervasive, impacting all areas of the financial services supply chain, from payments and remittances to asset management. And a wide range of non-financial actors, including mobile network operators, private sector startups, and other FinTech companies are emerging and playing an ever-increasing role in offering innovative financial services and products. Incumbent participants in the financial services industry have also taken advantage of technology, either through full collaboration or in some cases, partial collaboration. Alternatively, some incumbents have worked on technology solutions independently. FinTech can have a number of potential benefits. It can increase speed, enhance customer choice, and increase accessibility. In this way, consumers will get more choices, better targeted services and keener pricing. Small to medium enterprises will be able to access new credit. Banks will become more productive with lower transaction costs, greater capital efficiency, and stronger operational resilience. And financial services will be more inclusive, with people better connected and more informed about finance and access to financial services. Let's now look at the benefits from FinTech for financial inclusion. FinTech can directly have a positive impact for financial inclusion. As new tools and technologies are developed, greater access to financial services can be achieved, and cost efficiencies can make products more affordable. Innovations have the potential to improve supervisory effectiveness, especially in resource-constrained environments, such as through innovations targeting regulatory compliance, so that information can be produced and processed and later analysed in a more cost-effective and efficient manner, but also through developing new types of tools for supervisory use. For example, systemic risk modelling, machine learning, and big data analysis. Let's turn our attention to two case studies. M-Pesa is the world's leading mobile money service provider, launched by Vodafone's Kenyan associate, Safaricom. M-Pesa now operates in 10 countries, servicing some 29.5 million customers. It is used by more than 2/3 of the adult population of Kenya, and it is a firm that has emerged through the telecom industry as opposed through traditional financial services. And next, Ant Financial, which is a leading Chinese online payment provider, considered as the largest FinTech in the world by value. It has over 450 million users, handling close to 60% of China's online payments, yet it is not a traditional financial services firm. Now turning our attention to the regulation of FinTech. FinTechs are often delivering a small piece of the financial services supply chain. Therefore, they do not typically fit with the traditional types of licenses offered by regulators. FinTech innovations are therefore challenging regulators in terms of how to carry out effective regulation and supervision in a more complex and fast-paced environment, in a manner that does not stifle innovation but preserves the safety and soundness of the financial system. A fundamental question raised by FinTech is whether the existing regulatory architecture is readily adaptable to FinTech developments, or if more radical adjustments are needed. Several country examples of supervisory responses to FinTech are regulatory sandboxes. Regulatory sandboxes allow FinTechs to test their innovations in a monitored but more flexible environment. In this way, businesses can test innovative products, services, business models, and delivery mechanisms without immediately incurring all the normal regulatory consequences of engaging in that activity. Creating room for a test and learn approach for innovation, albeit paying close attention to innovations under minimum rules of engagement, may be key to fostering responsible innovation. Some supervisory agencies are adjusting their approach to supervision, but experience is mixed. Considerations include how to deliver a sandbox approach that lowers barriers to testing within the regulatory framework, while at the same time continuing to meet minimum standards for financial services firms. And finally, 2 examples of supervisory sandboxes. Both developing and developed countries show useful experiences in dealing with innovations in a flexible but safe manner, which can provide useful lessons for new countries. For example, the Central Bank of the Philippines implemented a test and learn approach for innovations led by non-traditional actors, such as mobile network operators, aimed to expand financial inclusion. Equally, the Netherlands Central Bank, earlier this year, established an innovation hub designed to provide a clear framework to deal with fintechs and innovate financial market participants. Thank you very much. For further information, please visit the IMF's website, imf.org.
Thanks very much, Christopher. Our next presenter is Robin Lewis, Research Analyst and Associate Fellow with the Center for Technology Innovation in the Governance Studies Program at the Brookings Institution. Welcome, Robin, and thanks for joining us today.
Thank you so much, Jerry. It is a pleasure to be here. So to get started, I should say that I work on the Financial and Digital Inclusion Project at the Brookings Institution, which is co-led by Daryl West and John Villasenor. So to get started today, I'd like to provide some context on what this project, which we call FDIP, is, and then how it connects to the topic of financial technology, or FinTech more specifically. Before we go further, it might be helpful to unpack the term financial inclusion a bit. So there are generally a few different definitions of financial inclusion, but there is a fairly broad consensus within the community that there are at least 3 components of financial inclusion, centering on access, usage, and quality. So in other words, people should not only have access to a suite of financial services, but these services should fit their needs, both in terms of cost and utility, and provide adequate protections for consumers. So the objective of our Financial and Digital Inclusion Project, or FDIP, is to provide policymakers, representatives of the private sector, NGOs, and the general public with information that can help improve financial inclusion in our focus countries and around the world. So with that background, our team is specifically focusing in the annual reports that we produce on examining access to and usage of formal financial services that are affordable, secure, and accessible to individuals who are either at the margins of or even entirely outside of the formal financial system. With that said, we recognize that informal products and services also play a significant role in the global financial ecosystem, but these are beyond the general scope of our study. So, as you can see from the slide, we have produced a second annual report in August of 2016. And what I'd like to do today is walk through some of the findings that we encountered through producing this report and highlight some specific regional examples and then a few concrete examples of where FinTech fits into our work. So now that we've identified what financial inclusion is, I'd like to briefly talk about why financial inclusion matters in the first place before we talk about our findings. The Global Findex, produced by the World Bank, has found that there are about 2 billion people worldwide who lack access to formal financial services. This is a significant problem in much of the world because formal financial services allow people to pay school fees, obtain credit for small businesses, purchase insurance, and they're also very critical for people who are often marginalized or underserved by the formal financial system, including groups like women who need access to these services and greater control over their finances. The good news is that digital finance is providing avenues to reduce income inequality, boost job creation, and help provide individuals who are at the fringes of the formal financial system with greater control over their financial lives. This is not only good for these groups, it's also very important in a macroeconomic sense. A report by McKinsey that came out very recently found that digital finance, including mobile financial services, could add about $3.7 trillion in additional annual economic activity by 2025. So we're interested in financial inclusion both for the benefits that it can provide individuals and also for the importance that it has to economies more broadly. So turning to our 2016 report specifically, we examined 26 countries all around the world across 4 dimensions of financial inclusion to try and get a sense of how governments and the private sector are doing in terms of promoting access to formal financial services, including through digital means. So now that we're focusing on the digital component, let's talk briefly about FinTech before going to some more specific examples. FinTech sits at the intersection of finance and technology, as you might have guessed from the name. But how does this concept connect to financial inclusion? Essentially, FinTech means that there are opportunities to use software and digital platforms to deliver financial services to consumers. This looks different throughout different markets, but the important component for us is that in a lot of emerging economies, FinTech companies can harness mobile technologies, big data, and also analytics to provide services to consumers in ways that are more convenient and accessible and intuitive. So turning to our scorecard and how different elements of FinTech fit into it, there are 4 dimensions that we assess of financial inclusion in the scorecard that comprises part of our 2016 report. These are country commitment, mobile capacity, the regulatory environment, specifically for digital financial services, but not exclusively, and adoption of traditional and digital financial services. So one broad example of the intersection of finance and technology that appears throughout these different dimensions of our scorecard is mobile money. So with mobile money services, customers don't necessarily need access to a bank account to engage with the formal financial system. One of the most widely cited examples is M-Pesa in Kenya, but in fact there are many, many others. In fact, as of 2016, mobile money was available in about 2/3 of low and middle income countries, according to the GSMA. That translates to about 277 live services across 92 markets. This type of FinTech is incredibly important throughout all different economies and geographies of the world because it enables people to access payment services and even more extensive mobile financial services, such as microinsurance in many countries, that enable them to engage with these services even if they're living in rural communities with limited access to banking services, but in places where there is significant mobile phone penetration. Mobile money has been particularly successful in places like sub-Saharan Africa, but it is broadly being picked up in different areas around the world. 30 markets around the world, in fact, now have 10 times more active agents than they do bank branches, showing that mobile money can proliferate in different contexts. So looking at country commitments specifically, now that we've provided an overview of FinTech, our report shows that substantial progress has been made toward advancing financial inclusion across a number of different contexts. Our top scoring countries in our scorecard primarily came from sub-Saharan Africa and Latin America, which has been due not only to country commitment, but also to regulatory environments in many of those contexts, which we'll discuss a bit more later. Moving to mobile capacity, interestingly, a number of our top scoring countries in terms of mobile money adoption, including Kenya, Uganda, Tanzania, and Rwanda, were not among the top scoring countries with respect to mobile capacity. We think this might actually herald good news because it means that with increased build-outs of mobile capacity and other forms of financial technology, these countries will be well positioned to improve their overall financial inclusion. As I mentioned briefly when referencing different forms of FinTech, a number of countries are already diversifying the types of mobile financial services and other technologies that they offer. One example is a service called M-Shwari in Kenya, which enables both savings and loan accounts through mobile phones. And in fact, in 2016, there were over 100 live mobile-enabled insurance services available in about 31 emerging markets. This is up from just 41 live services as of 2011. These types of mobile insurance services are crucial, especially in agrarian communities and other contexts within emerging markets, because they enable people to plan for the future and avoid financial shocks. Moving to regulatory environment, we have found that focusing on the service provided rather than the provider of the financial service is an important step in helping to facilitate a more broadly enabling regulatory environment. This is true for different forms of FinTech, not just mobile money. But as an example, we found that in Tanzania, an enabling regulatory environment has helped facilitate what's called account-to-account interoperability in mobile phones. This type of interoperability in which people who are on different mobile networks can easily send money to one another means that more people can join more services and engage with others across different networks, which helps these services reach scale and provides more functionality for consumers. We also found, as another example, a service in Peru that is a shared mobile money platform called BIM, which represents a collaborative effort led by an association of banks to interconnect banks and various mobile money services. These are very exciting developments throughout the global financial inclusion ecosystem that we hope will continue to bring more and more people into the formal financial services network. The final component of our scorecard is the adoption of traditional and digital formal financial services. So although we often talk about finance, digital finance, and technology, it's important to remember that all of these elements can serve complementary aims between what we often think of as the more traditional formal financial services sector of banks and these new emerging startup entities and other financial service providers, whether those are post offices or whether those might be mobile network operators that enter into the financial services space. So as an example, mobile money is actually arguably strengthening much of the banking industry. For example, between September 2015 and June 2016, the volume of flows to and from bank accounts grew by more than 120%, according to the GSMA. So it's encouraging, we think, to look at the broader global financial ecosystem and see the ways in which consumers can become onboarded to these accessible, financially and technology-oriented products and services. And then once they've become a part of the formal financial ecosystem through mobile money and other means, they can then access more extensive services that might have otherwise been closed off to them. So we found, for example, in one region that sub-Saharan Africa, as I mentioned, has continued to take a leading role in the share of registered and active mobile money accounts. But a number of other regions, including in South Asia and Latin America, are also finding that increasing mobile penetration and particularly smartphone penetration are laying the groundwork for increased financial inclusion. Moving to some of the calls to action that we found throughout the course of our study, we looked at 4 different key action items that we hope members of the financial inclusion community and governments will act upon in order to continue to advance financial inclusion. I'll focus on the few that connect specifically to FinTech. The first being that we can collect and analyze data using different forms of financial technology, for example, through alternative credit scoring algorithms that leverage social networks, to find areas and opportunities for private sector entities to serve currently underserved customers. So this is an exciting development we found that enables different groups that are entering into the formal financial ecosystem to use their data algorithms and other skill sets to provide information about the state of financial inclusion and also to directly facilitate financial inclusion. We also found that advancing enabling regulatory changes that recognize the value that different entities can provide in coming into the financial services network, regardless of their status or non-status as a traditional player, is very crucial. So we hope that more and more regulators and other government and non-government entities will recognize the value of these non-traditional players and help to facilitate those complementary relationships between different financial service providers based on what they can do for consumers rather than necessarily what the entity has been labeled as. And finally, FinTech can play an important role in enhancing financial capability for a number of reasons. One of these is that these different FinTech services can use different messaging systems and other digital platforms and means to provide financial capability messages to individuals who are at the margins of the formal financial system. So this heralds new opportunities to conduct outreach about why formal financial services can be beneficial and also how to engage with those services. So there are a number of companies and startups that are doing work in this space, and organizations like the Center for Financial Inclusion at ASEAN have enumerated several of those in much of the work that they have done. So we encourage you to read the 2016 report that our team produced for some of those examples, and also to read the work of other colleagues in this space who are focusing specifically on financial capability efforts. Finally, moving forward, we encourage any feedback that you might have on the 2015 or 2016 reports Please send any comments to the address on the slide, fdipcomments@brookings.edu. We will be producing our third annual report, which will be published in late summer of this year. So if you have any thoughts on the methodology, examples of FinTech that we should be including or looking at, please feel free to send us those thoughts. And thank you all so much for your time.
Thank you to both our speakers today, Christopher Wilson and Robin Lewis. And thank you to everyone who joined us today. We hope you found our webinar informative and relevant. Questions submitted during the session will be responded to you by email. And shortly, a survey will be sent to let us know how well we did and what you'd like to hear on future webinars. An archived version of this webinar can be found on the Toronto Centre website. We look forward to receiving your feedback and hope to see you again here soon. Thank you and goodbye for now.